4 Best Profitable Scalping and Swing Trading Strategies for Beginners. This video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, or any financial markets and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high-probability trade using these strategies. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Scalping trading is still one of the most popular types of trading. However, many people fail at scalp trading because they do not follow a set of scalping strategies and trade based on their mood. Scalping and intraday trading are becoming increasingly popular, owing to the potential for quick profits. The strategy's principles are based on capitalizing on frequent and sometimes minor price movements. Risk management is important because losses must be limited, and identifying the right market conditions is critical. Let's look at some of the most popular scalping and swing trading strategies for beginners that can help you profit from the market. First, Open High and Open Low Trading Strategy. The Open High and Open Low strategy is one of the best scalping and swing trading strategies for beginners to learn. Although the accuracy rate varies between 50 and 70%, this strategy can help you succeed in intradays and swing trading if used with proper risk and money management. When open equals high for the previous candle, market began falling with heavy selling pressure almost immediately after the market opened. Similarly, when open equals low, it means that buyers began buying that stock as soon as it opened, and if open equals low for the previous candle, market began raising with heavy buying pressure almost immediately after the market opened. Some features of Open High and Open Low strategy. Since now we have become acquainted with the whole concept of Open High and Open Low strategy and know what it is, let's take a quick look at some of the features of this concept that might help you further to get a clearer idea of how this whole strategy works for a trader during trading. Having a high risk-reward ratio. Usually, the process of the strategy of Open High and Open Low carries a high risk of reward ratio. This generally happens because intraday trading works slightly differently, and the strategy of Open High and Open Low enables the investors and the traders to set up a stop losses near the strike price under the intraday method of trading. Analyzing long-term stock charts. One of the most distinct and distinguished features of the Open High and Open Low strategy is that it is required by the traders to analyze the intraday charts of long-term stocks. The prime recommendation of the experts, especially for the investors and traders who follow the intraday method of trading, is that they should refrain from investing against a stock's trend. Hence, it is crucial and very necessary for the traders to have an idea about the trends of the stocks they are looking forward to selecting, and that's why carrying out a complete analysis of a weekly or maybe a monthly report might be a good idea. Here are other examples of the Open Equals High and Open Equals Low trading to fully understand this wonderful strategy. Second, Breakout Trading Strategy. The breakout trading strategy is one of the most popular trading strategies for selecting good markets. This strategy focuses on the markets that move above or below specified levels. These are known as support and resistance levels, and once the price moves above resistance, it continues to rise. Similarly, if the price falls below support levels, you can enter a short position in the stocks, assuming the price will continue to fall. Finding a good candidate. When trading breakouts, it is important to consider the underlying support and resistance levels. The more times a price has touched these areas, the more valid these levels are and the more important they become. At the same time, the longer these support and resistance levels have been in play, the better the outcome when the asset's price finally breaks out. As prices consolidate, various price patterns will occur on the price chart. Formations such as channels, triangles, and flags are valuable vehicles when looking for the market to trade. Aside from patterns, consistency and the length of time a market price has adhered to its support or resistance levels are important factors to consider when finding a good candidate to trade. Entry points. After finding a good instrument to trade, it is time to plan the trade. The easiest consideration is the entry point. Entry points are fairly black and white when it comes to establishing positions on a breakout. Once prices are set to close above a resistance level, an investor will establish a bullish position. When prices are set to close below a support level, an investor will take on a bearish position. To determine the difference between a breakout and a fakeout, wait for confirmation. For example, fakeouts occur when prices open beyond a support or resistance level, but by the end of the day, they wind up moving back within a prior trading range. If an investor acts too quickly or without confirmation, there is no guarantee that prices will continue into new territory. Here are other examples of the breakout trading to fully understand this wonderful strategy. Third, pullback trading strategy. Learning how to trade pullbacks can be a great skill as a trader. Pullbacks happen all the time, and if you learn how to trade pullbacks, you can enhance your repertoire and find many more high-probability trading scenarios. A pullback occurs when the price of a stock or commodity pauses or goes against a prevailing trend in the market. It is a temporary dip in a generally upward trending asset price. Unlike reversal in which there are more permanent price drops, a pullback remains only for a short while. Pullback trading is a trading strategy in which we enter the markets during corrections or pullbacks. When market is in an uptrend or a downtrend, it will make small moves in the opposite direction of the major trend. For example, if a stock is in an uptrend, it may pull back and show some correction before resuming its major trend. Similarly, if a stock is falling, it may experience a brief rebound before resuming its downward trend. Pullback trading is a trading strategy in which we catch the market in a correction, in an uptrend, or on a bounce back, in a downtrend. Here are other examples of pullback trading to fully understand this wonderful strategy and to make the most out of it. 50-period exponential moving average trading strategy. As a technical trader, we have all heard about keeping a trading system simple and effective, and it is not a surprise to see most of the successful traders often glaring at clean charts with price action on the forefront rather than fancy colorful indicators. I am not a stark opponent of indicators, but do seem to cringe when I see multicolors on the chart that overshadow good old price action. You should keep indicators to a minimum and only use them where they make sense. In this video, I want to lay out a simple trading strategy based on literally just a single moving average and some basic knowledge of how price action works. You are free to adopt it, of course, but the real idea is to set an example for how simple trading really has to be. The moving average strategy setup. Starting with a clean chart with nothing but candlesticks, lay out the 50 exponential moving average, or EMA. Believe it or not, we are ready to go. Things get interesting for us when price returns back to the 50 EMA after having spent some time away from it. If you've followed moving averages closely in the past, you would likely understand that I am basically hinting at trending price action. When price runs sideways, moving averages tend to close in and will get entangled with the ongoing live action also getting hit quite frequently by price. For moving average-based systems, that can be account killing. As a simple filter to this problem, you should only be interested when price touches the 50 EMA after relatively spending some time away from it, as when it shoots off into a decent trend. Let's look at some of the points on the same chart that we might be interested in. Notice how each of the two touches of the 50 EMA result in a bounce, and that they occur as a follow-up to a strong move prior. It is not uncommon for price to bounce harder from the 50 EMA the more time that it spends away from it. The filter. When not to trade. We have already talked about an important filter that can help you quickly eliminate the weaker setups from the stronger ones. Trading only in a trending market where price does not hit the 50 EMA in quick succession. Let's also talk about another extremely crucial filter, horizontal support and resistance levels. I am excited every time I see price pulling back to the 50 EMA following a strong move, but my fingers will not roll over the order button until I find the point where price touches the 50 EMA is lying in confluence with a horizontal former support and resistance level. I have found this to be an amazing filter. Sure, I miss a few trains, but the ones I take, I sure as hell enjoy the rides, mostly. The entry trigger. Now that we know the dynamics of the system itself, let's look at the two ways that I believe you can trade this method, ranging from a conservative approach to an aggressive one. The aggressive approach. This approach allows you to execute an order upon the touch of the 50 EMA. The stop loss will need to be placed arbitrarily a few pips above or below your entry, as the case may be. Notice that such a trigger would have worked phenomenally. Price hits the 50 EMA and bounces hard. Here are another examples. The conservative approach. For those who like their peace and relaxed lives, there is the alternate approach, where you can wait for a definite price action signal at the bounce of the 50 EMA in the form of a candlestick pattern like a pin bar or an engulfing bar pattern. In this example, the chart shows a nice pin bar off the 50 EMA and a horizontal support and resistance level. You can now take your trade as you conventionally would if you were trading the pin bar. That is, taking an entry at the break of the pin bar with the stop loss objectively placed at the break of the other end of the bar. Personally, I prefer to wait for a price action confirmation because I have been an avid fan of candlestick patterns my entire trading career. Although very occasionally I will also take touch trades when I see a mountain load of dead obvious confluence of support and resistance areas lining up at the touch point. Here are other examples of the conservative trading with 50 Parrot EMA. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. So, if you can learn to combine the two, 50 EMA and support or resistance area, you have a mighty effective trading system. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.